Welcome to our guide on the tax implications for Canadians moving abroad. We'll delve into the complexities surrounding investments like tax-free savings accounts and other financial considerations when relocating to a new country. In this video, we'll cover several key topics: understanding the tax implications of leaving Canada, impacts on tax-free savings accounts, considerations for non-registered investment accounts, timing and asset disposition considerations, best practices for managing financial changes when moving, and some important disclaimers. When a Canadian resident leaves the country, the tax implications for their investments can depend on several factors, including their residency status, the type of accounts held, and the timing of asset disposition. For our discussion, we assume that all assets are held in Canada. A TFSA offers tax-sheltered growth on investments. However, leaving Canada does not trigger an automatic tax event for TFSA assets. A deemed disposition of assets happens when the account is closed or when your residency status changes. Ultimately, there is no significant tax difference in closing your TFSA before or after your move, as long as it happens within the same tax year. However, you must follow the rules and regulations of your current residency. Similar to TFSAs, non-registered investment accounts are subject to capital gains taxes upon disposition. Leaving Canada does not automatically trigger a tax event for these accounts. You'll be taxed on gains only when you sell your investments. Again, closing the account before or after moving to another country is irrelevant, as long as it's within the same tax year, subject to tax regulations of both countries. It's time for a quick quiz. When does a deemed disposition occur for a TFSA when leaving Canada? Here are your options. A. When you sell investments in Canada. B. When the TFSA account is closed. C. Automatically upon leaving the country. D. Every tax year. You may pause the video now to think about the answer. We'll discuss the correct answer in the next section of the video. The correct answer is B. When the TFSA account is closed. A deemed disposition occurs when the account is closed, or when your residency status changes, resulting in potential capital gains or losses. This timeline diagram illustrates the importance of considering the timing of asset disposition when moving abroad. The timing of selling your investments and closing accounts can have tax implications, particularly concerning capital gains or losses. The market conditions and your financial situation should drive your decisions. There are several best practices to keep in mind, such as consulting a tax professional in both Canada and your new country, maintaining thorough records of all transactions and asset values, understanding the current tax laws and regulations in both countries, and planning ahead for the account closure process and tax preparations. This information is intended for educational purposes only and does not constitute tax or financial advice. Tax regulations are complex and vary, so seeking professional guidance is always recommended. In summary, understanding the tax implications is crucial when moving to a new country. Both TFSA and non-registered accounts have similar rules on dispositions. Timing your financial decisions carefully and consulting with tax experts is vital for excellent financial planning. Thank you for watching. We truly appreciate your time. If you found this video helpful, please like, share, and subscribe. We'd also love to hear your thoughts in the comments. What challenges have you encountered while moving abroad? Let us know.